Well, hello and welcome back to Principles of Accounting 2. I am still your host, Dr. B. Happy to have all of you with us today. This is fantastic news. We have almost the entire class here on the call, which is awesome. I sincerely appreciate all of you being here. And also, I want to say and highlight the fact that all of you completed that QuickBooks, LinkedIn Learning in that first week. And so thank you to all of you for doing that. Hopefully, you're seeing the value in completing that QuickBooks LinkedIn Learning module. I think that by you learning QuickBooks is beneficial, regardless of whether you're an accounting major or not. Okay, most of you are not, and that's okay. I think that understanding QuickBooks and knowing that 85, roughly 85% of businesses, small businesses here in the United States uses QuickBooks is powerful stuff. And the reason why I say that is because you can use this with any employer. You know what I mean? Like, this is a big deal because when you can say to an employer, hey, I know how to use QuickBooks, I mean, that's huge, right? And it's on you can put it on your resume? Absolutely you can. Yeah, put that on your resume. It's a certificate. You know what I mean? Put it on your resume. Put it on your LinkedIn profile. Highlight that fact. Yeah? It's an accomplishment. So, thank you to all of you for doing that LinkedIn I'm sorry. Yeah, for LinkedIn Learning QuickBooks online certificate. The first of a few in this course. And so just knowing it is really, really great. And so thank you. I can't thank you enough. And hopefully you're seeing the value. So that was week one. We got through week one. We're already in the middle of week two. This past Monday was a holiday, as you know, so we didn't have class. I did post a recording from last semester just to kind of get you started thinking about this week. So in this week, here we are in week two, we're going to be discussing how to analyze a company and their financial health, right? That's the really the premise of this week. This is what I like to call a continuation or a bridge from Principles of Accounting 1, because we're going to be looking at the income statement, balance sheet, statement of cash flows, a little bit of statement of retained earnings, and analyzing those financial statements. Okay. Uh, in business, it's so important for you to be able to analyze financial statements and understand the company's financial health and be able to do that in a couple of different ways. Because sometimes looking at just the financial statements and looking at the differences from year to year isn't really all that meaningful. So, in order to make it meaningful, we look at things like ratios, um, we look at trends, we look at a lot of other different ways of analyzing the financial data. So, as a manager, that's going to help you in the long run because it is really important to be able to analyze the financial health of the company at any given point in time. So that's why I think you'll see value in this week. So here we are in the classroom. We're in week two. Feel free to go through that week at a glance. It talks about what we're going to be looking at. There's a couple of other really good pieces of information in here that help you to connect the learning objectives for this week to the course learning objectives. And of course, what do we got going on this week? We're going to be looking at chapter 17, which is the financial statement analysis chapter. And then within that, uh, in the instructional materials, there's some additional components here. The PowerPoint presentation we're about to go over. And then as you scroll down, there's a couple of really short videos that help to really just kind of connect things in a more visual way. And then if there's a LinkedIn Learning video. Now, this LinkedIn Learning video, it doesn't get submitted. There's no, it's not like a certificate like you did last week. This is just the video. Okay, it's just additional content to help you. And you'll be able to find that right here under the materials. Again, just a video. There's nothing submitted with this part of the LinkedIn, yeah. It's just a video to help you to better understand the content. And then under Engage and Explore for this week, we have a discussion board. Some of you have already been posting in here, and I love it. Thank you so much for doing that. It's important that you do that because by tomorrow night, you should be posting your original post. Okay? So, and the reason why I want you to have this done by tomorrow night is because it allows you time to be able to respond to two of your classmates. Okay? Ultimately, you need to have three different posts, one original post and two responses to your classmates for this discussion board. Okay? Oscar, what you got here is great. Crystal, this is great. Maria got us started. Thank you, Maria. All of these are really helpful. Okay. So, in looking at what your classmates wrote, I want you to continue that momentum. All right. So, have your original post completed by tomorrow night and then respond to two of your classmates by Sunday night. Yep. The responses need to be done by Sunday. Original post tomorrow, by Sunday night, two responses. Yep. So that's the discussion board. And then, of course, we'll have the Chapter 17 quiz. Remember, for every single quiz in this course, there are 2 attempts that you have at that quiz, and the higher of the 2 attempts will be taken into the grade book as your grade for that quiz. Okay. So just something to keep in mind if you're not happy with the first attempt. Yeah. Okay, without further ado, let's go ahead and jump into our conversation for today, which is analyzing financial statements. And let me go ahead and get us set up and do the fancy swap. And there we are. Cool. Thank you. And again, if you have any questions as we're walking through and talking about these things, please feel free to unmute your microphone, ask your question. You can raise your hand, you can unmute your mic, you can type it in the chat, whatever you're comfortable with. Okay. So, in this chapter, we talk about how to analyze financial statements from really 4 different perspectives. And these different perspectives help us to look at financial statements like the income statement, balance sheet, statement of cash flows, statement of retainers in a meaningful way. Okay. The reason why we do this as managers is because it helps us to better understand the overall financial health of the company. And not just from a managerial perspective, you can also do this from an investor perspective, a bank perspective, a customer perspective. In business, it's so important to know where you stand at all times. And by using these simple methods of analyzing the financial statements, I promise you it'll provide you with insights into your business. Okay. I know that a lot of you, you're in different fields. You're in mortuary science, hospitality, you have a small business, you're working for someone else, you're working in management, you're doing all these awesome things. At some point in time, you're going to look at the financial statements of that company. And you're going to want to say, okay, so how are we doing? Right? And I'm going to show you how to analyze that. How are we doing? So, okay, let's take a look at these methods. We're going to start by figuring out who's interested in looking at the financial performance, and we're going to look at what we call the building blocks. These are the different methods of analyzing the financial statements. Okay, so why do we analyze the financial statements? We need to understand the past and current performance of the company. We need to understand the current financial position of the company. And we also need to understand what the future performance might look like from a trend perspective. What happened in the past usually informs what will happen in the future. We also look at, things like the budget. And we also look at potential future risk for the business. So as I mentioned, it's important to look at this from a couple different perspectives, right? As managers, yeah, we definitely need to know what's going on in our company. The officers of the company are also interested. Internal auditors Definitely. But who might also be interested in the financial health of the company? Shareholders. Yeah. Before I invest in any company, the first thing I do is I run through a couple of ratios, trend analysis, and I read through their financial statements to understand the direction of the company before I make an investment decision. Okay? So, as a shareholder, I'm interested in doing this type of analysis. Lenders, these are the banks looking to lend money to the company in the future. Yeah, I'm going to want to know that they're able to pay me back at some point, right? And suppliers. The reason why a supplier would be interested in understanding the financial health of the company is because they might be interested in extending a line of credit or credit terms where the business can buy supplies from the vendor, right? On, a 30-day rolling basis. It's like, okay, you buy the supplies from me, pay me the supplier in 30 days from now. And so that's why a supplier would also be interested in understanding the financial health of the business. So, as I had mentioned, there's four ways of looking at the financial performance, financial health of the business. And there are what we call the four building blocks. The first one is called liquidity and efficiency. Can anyone on the call today, can you tell me what is liquidity? What does that mean to be liquid? I don't understand. What is liquidity? What does that mean?
How easily the asset is transferable to cash.
I- Yes, absolutely, Dom. Yeah, you got it. Dominic, you nailed it. It's how quickly the business can convert assets into cash. For example, how quickly can I sell through my inventory, convert that into cash? How quickly can I collect my accounts receivable from customers that owe me from previous purchases? How quickly can I convert that into cash? And then property, plant, and equipment. That's a little bit more challenging to sell, but it takes a little longer. But overall, liquidity is super important to look at. Yes. So it's how quickly we can convert things into cash. We also look at what we call efficiency, and that has to do with timing. Okay. And we'll talk about those a little bit more in detail. But yes, thank you so much for that, Don. Okay, so there's three other ones. Next one is called solvency. Solvency. What do you think solvency means? What does it mean to be solvent? Any thoughts? Solvency. Maybe it's possible you haven't heard this term before. But what do you think? Solvency. Michelle.
Um, is it dealing with like the future, like the opposite of liquidity being like short term? Would this be like in the
Yeah.
future?
Yeah, yeah, absolutely. It's definitely future and a little bit short term, definitely. And so, I mean, thinking about the term solvent, and Ashanti, you're absolutely right. It has to do with the future more than the short term. But what solvency essentially means is that the business looking into the future has the ability to pay all of its debt. Okay. So, in other words, the business needs to be able to satisfy its short term and long term debt, right? So, like, if I need to make sure I have enough assets, okay, in the business to take care of all my debts, right? We call that solvent. It means that we have the ability to go out of business and not owe anyone anything when we close. You see? So solvency. So in that we look at ratios to understand if the company has the ability to pay its current short-term and long-term debts. Okay, so solvency. Yeah, very well done. The next one, hopefully, is obvious. Profitability. This is the company's ability to generate a profit. Okay. We want to satisfy our shareholders. We want to satisfy management. We want to make sure that everyone's happy. And how do you do that? You be profitable, right? That's the idea. That's why anyone goes into business. It's to make a profit. And I'm going to say something that might be a little controversial. I'm going to say even a nonprofit business goes into business to make a profit. Okay. I know I can hear some of you, Dr. B, that's not what nonprofit means. Yes, it does. We just call it something else in a nonprofit business. Call that revenue. The difference here is that the profit that a nonprofit business makes, we don't call that profit because we're not taking that profit and giving it to shareholders. Okay, a nonprofit business doesn't have shareholders. Nonprofit business, their mission is something of a charitable nature typically, and so they will retain that profit in the business to satisfy the future needs of that nonprofit agency. You see, so that's just a little side note, but I just wanted you to have an understanding that every business is in business to be profitable, even nonprofits. Right? And then the fourth one is called market prospects. Market prospects is a way for the business to be attractive to future investors. Okay, market prospects. The business needs to attract new investment, oftentimes. Okay, how do we do that? We make sure that the business is profitable, we make sure that it's operating appropriately, and we try to satisfy our current shareholders. And we try to raise the value of our share price to attract new shareholders. Okay, so we call that part of business market prospects. There's a lot of ratios that we use in market prospects, and we'll talk more about that as a presentation goes on. But those are the four building blocks for analyzing financial statements. And so next we're going to talk about the type of financial statements that we look at and some information on those financial statements. So here we have the four basic financial statements that every business has: an income statement, a balance sheet, statement of cash flows, and the statement of retained earnings, also known as stockholders' equity. Okay? Those are the four basic primary financial statements of every single business. Okay? Every business on the planet has those four financial statements. Okay? Even if it's a private business. How's that, Dr. B? They use QuickBooks to generate these four financial statements. And, obviously you're learning about that part as well. Every single business, even if it's privately owned, has these four financial statements. The reason why every business has these four financial statements is because as a business, the primary objective is to generate a profit. And how do we know we've generated a profit or not? It's by looking at these four financial statements. Yep. So, food for thought. The fifth one you see here is called notes to the financial statements. Just as the name implies, they're notes to each of those four financial statements. Notes involve things like management, discussion, and analysis, which is a really fancy term for saying, what does management think about the direction of the company? Okay. There's other notes like transactions that have occurred, like paying off certain debts or issuing new stocks and bonds and those kinds of things. So that type of information will be in the notes. And so we look at the income statement, balance sheet, statement of cash flows, statement of retained earnings, and the notes in order to analyze the company's financial statements and to understand the overall financial health of the company. So when we look at this type of things, we need to compare them to something, right? I mean, just looking at financial statements is nice, but how do I know how well it's doing? Right? It's like, oh, here's an income statement. Oh, it looks like they have a positive net income. That's good. But what the hell does it mean to me? You know, what does it mean to the business? Right? If I'm a manager of the business and I'm looking at my income statement, I'm saying, great. What does it mean? Right? I, I have a positive net income. That's a good thing. But what does it mean? Who cares? As a manager, I care because my job is to make sure that the company's generating a profit, right? My investors care because they need to know that the company's generating a profit. We benchmark the performance of our company looking at the income statement, balance sheet statement, retained earnings, statement of cash flows, and we compare them to a couple of different things to benchmark them to say, yeah, we're performing and we're performing well in comparison to other parts of the company, like other divisions. Sure. We look at competitors. Definitely. I like to think of, Coca-Cola and Pepsi. Okay. Oh man, huge companies. They're both in the uh, drink space. Yeah. And they're both really, really big. And you'll notice if you ever look at the financial statements of those two companies, they report them a little differently, right? One's in thousands, one's in millions. Okay, it's just the way that the reports are done. Yeah. So how can you compare two different or similar companies and understand who's doing better? We go through financial statement analysis. Okay. I'm going to show you what the other tools look like to do that. So, yeah, we need to benchmark our performance against our competitors. We also look at the overall industry averages. Okay, so for example, if you just do a simple Google search, you could figure out the industry averages for the financial performance of, let's say, hospitality company. Okay. Let's say you work for Marriott. All right, you work for Marriott, and your competitor is Choice Hotels, or your competitor is Hilton. Okay, so you got Marriott, huge conglomerate. You got Hilton, huge conglomerate. Their market share, if you look at their market share, is huge. Okay, they control the majority of the space, right? And so you want to compare these two companies together. You also want to compare your company Marriott to the industry average, as in how do I compare to my peers? And of course, we also look at, are we meeting certain guidelines and standards and things like that. But these are the standards for comparing the financial health of our company to others. And we need to benchmark it in these ways. So I had mentioned that when you're comparing two different companies that have similar financial statements, we can look at them in a couple different ways. All right. And if we're looking at our own company, we can also look at that in a couple different ways. These are the three tools that are most commonly used when it comes to analyzing the financial performance of your company. The first is called a horizontal analysis. And what this horizontal analysis does, think of the horizon. It goes left to right, yeah? Horizon. It's the x-axis, right? The horizon line. We're looking at the company's financial performance across multiple periods. Okay. Typically, it's from year to year. The company did pretty darn well in 2023. I want to see what were the changes in each line item on the income statement and balance sheet as it compares to the performance of 2022. And I want to see the difference of 2023 as it compared to 2021. You see, I'm looking at the financial performance across time for each line item on the income statement and balance sheet. And I'm calculating the percent change and the dollar change when I look at that comparison. Okay. We'll talk more about that here briefly, but that's horizontal analysis in a general sense. The next tool that I use is called vertical analysis. Vertical, as the name implies, is up and down the financial statements. Okay, up and down. Here's what this means. I look at the performance of the company using the income statement and the balance sheet, and I want to find the percentages of utilization, okay, for the income statement and balance sheet. Here's what I mean by that. On the income statement, I look at every single line item, okay? And I base all of these items from a percentage of total revenue. A percentage of total revenue on the income statement. And I take whatever line item I'm looking at, I divide that by percentage of total revenue for that year, multiply that by 100, that gives me the percentage. Okay, and I do that for every line item. And what that does is it tells me how much percentage of each line item is made up from total revenue, right? Total sales. That's called vertical analysis. On the balance sheet, I do the same exact thing. The difference here, I don't have total revenue on the balance sheet, right? I use total assets as the base. Okay, total assets. I take every line item on the balance sheet divided by total assets. Multiply that by 100 to get the percentage. What that does is it tells me the percentage of each line item on the balance sheet as it relates to total assets. Okay. Why is that so important, you might ask? Because you need to understand the utilization of all your assets, liabilities, and equity as it relates to total assets. Okay. And I do that for every single year to compare them. Yep. So that's vertical analysis. The third tool that's very commonly used is called ratio analysis. As you recall from Principles of Accounting 1, almost at the end of every single chapter, I had you go through a couple of ratios, remember? I know some of you remember because you're like, oh, Dr. B, these ratios, man, I tell you, you're killing me with these things. I remember. I remember you saying that to me, right? Oh, I know you did. Why are ratios so important? You know, there's a reason why I had you calculating ratios every single week in Principles of Accounting 1. And guess what? You're going to do that again in Principles of Accounting 2. Why? Because it provides you with a indicator of how well the company is doing, right? That's why ratios are so important. Yeah. And they also help us to benchmark to the industry, competitors, etc. So those are the three primary tools that we use to analyze financial statements. So Now I'd like to talk about the horizontal analysis in a little bit greater detail, and then we'll do vertical, and then we're going to go through a lot of ratios. So buckle up. Okay, horizontal analysis. As I'd mentioned, we're looking at financial statements across time. I'm comparing 2023 to 2022's numbers. I'm comparing 2023's to 2021 numbers. And I'm looking at all 3 years at the same time. The reason why we do horizontal analysis is to discover trends. Yeah, I'm looking at the changes in both dollars and percentage. I need to know the trends. For example, on the income statement, if I'm looking at my total revenue and all my different expenses, and I notice like a large percent change from year to year, as a manager, that's a red flag. It says, man, something must have happened. What happened that year? So I'll look and be like, oh, okay, well, the reason why our electric bill was so much higher is because, we installed a new line at the factory. Okay, that explains it. Or oh, my revenue was a lot higher because I had a new contract with a new vendor. Okay, that explains the dollar change, a percent change in sales. Yeah. So that's why horizontal analysis is really useful. It helps you identify the trends across years. So how do we calculate it? How do we calculate it? First, we figure out dollar change. The dollar change is very simple. Okay, it's the current year or the analysis period minus the base year. The base year is typically going to be your oldest year on the financial statement. Okay, here's what I mean by that. On the income statement, we typically look at 3 years at a time. So I would look at 2023, 2022, and 2021. My base year is going to be 2021. Why? Because it's the oldest available information on that statement. Okay, so that's typically your base year. And so I look at the dollar change. So I'll take 2023 minus 2021. And then I'll look at 2022 minus 2021. What that does is it helps me to look at that dollar change from year to year. Yep. Okay. So the base year is typically the oldest one, typically. Unless otherwise specified, but yet to. So now that you know how to do a dollar change, I also want to do a percent change. And a percent change works very similarly. Okay, we take the analysis time, 2023, minus the base amount, 2021, divided by the base amount, 2021. Then I multiply that by 100 to get the decimal converted to a percentage. Okay. It's the easiest way to do it. Okay. So here we have a very short example. We have 4 cases. Okay. And these 4 cases, I'm comparing the 4 cases. They could be 4 companies, whatever. Okay. So here we have the analysis period minus the base period. Analysis period minus the base period. Analysis period minus the base period. You see where we're going with this. That gives us the dollar change, right? Just like we saw in the last slide. How do we do the percent change? Analysis period minus the base period divided by the base period. So if I go analysis period minus the base period, I get 6,000 divided by 4,500. That'll give me my percent change. You see? Analysis period minus the base period minus 3,000 divided by 2,000. That gives me my percent change. You see where we're going with that, right? So I do that for every single line item on the balance sheet and on the income statement. Now, here's the difference. As I had mentioned, on the income statement, we typically see three periods of time. 3 years. Yeah. 2023, 2022, 2021. That's on the income statement. On the balance sheet, you'll typically only see 2 years. 2023 and 2022, for example. And so here is what this looks like on the balance sheet, right? So, as I had mentioned, we do this for every line item. Current year minus the prior year, or the base year, gives us the dollar change. We take that dollar change, divide that by the base year, prior year, you get the percent change. You see? You can do this in Excel. Yeah, definitely. I always recommend you do this in Excel because it's easiest, right? Format's there. It's just a matter of the formulas, yeah? This cell minus that cell divided by that cell. You can see the percent change, yeah? But we can see, looking at this, the trend. The trend. That's what we're looking for, okay? Percent change in cash on the balance sheet. Wow. Wow. We got a lot more cash on hand. Okay, interesting. 88%. That's a huge difference. All right. To me, that stands out as an investor. I might say, why? Why do they have so much cash? How come they're not using that cash to pay down their liabilities? Or, you analyze it, right? That's the whole point. Now look at this. This part's interesting. This is Apple, by the way. Total assets. The percent change was minus 7.4%. Obviously we went through, we added up all the changes, right? 338 compared to 365 from the prior year. That's a $27,000 difference. That's a minus 7.4% change. Okay, that's interesting to me because it tells me that something happened. Obviously they maybe sold some assets. That could be what happened. Probably what happened. Because you can see it right here, right? You see the differences. They sold some investments that they had, long-term marketable securities. And they also sold what appears to be some property, plant, and equipment. Okay, and so that tells me right there, that's what that changes from, the 7.4%. Okay. You'll also notice as you go down, during the dollar change for each line item on the balance sheet, you'll notice that this total assets, 7.4%, is the same as total liabilities plus equity, 7.4%. You're saying, Dr. B, what's going on here? Remember the accounting equation? Assets equals liabilities plus equity. So total liabilities plus equity is going to be the same as assets, total assets, every single time. You see? And this is also how you know you've done your calculations correctly, is as long as your total assets shows the same dollar change and percent change as your total liabilities plus equity, you've done it right. You see? This is a pretty cool thing because it helps us as managers of the company and then, potential investors, customers, whatever, to understand the trends of the business. Then, of course, we do the same thing for the income statement. As I mentioned on the income statement, we base it off of total sales, right? So here we are looking at the horizontal analysis for the income statement. Dollar change, percent change, and I go down the list. And these trends are very interesting. Now here is only 2 years worth of data, but we typically see it as 3 years of data on the income statement. But just keep things simple. We got 2 years here. Yes, sales are a little down. Okay, cost of sales is a little down, so that makes sense. That should be also true. Gross margin is a little down. That makes sense, right? Because sales minus cost of goods sold equals gross margin. Remember, and then we have all of our expenses. We see that R&D is way up. Okay, that tells me that the company is thinking about making a new product or is working on making a new product. As an investor, when I see that type of information, that makes me happy. Yeah, because that means the future looks good for the company. That's the only kind of expense I want to see real high, and then we go down the list. Yep. But again, shows us the changes. That's why it's important. So, in talking about these trends, there's another formula that we can apply called the trend analysis. And this shows me the trend percentage. Okay. It helps to visualize over multiple years the percent change in a logical way. So the way we do that was we take the analysis period, so we'll say current year, and then we divide that by the base period. Let's say we're looking at 5 years of data. So 4 years ago, so year 5 would be my base period amount. And I multiply that by 100 to get the trend percentage. All right. So I can apply that to, again, this is Apple's data. I could apply that, right? So if you look down here, how do we get 111%? Well, we took the analysis period amount, in this case, the 260 from the current year, divided by the base period amount, which would be 233 from 5 years ago, to get 111%. Okay, and you'll notice that I do that for a couple of different years, right, in order to understand the trends. Yeah. So it's just a really cool way to look at things from the time horizon. Yeah. So we can also graph that information. Again, Excel, very helpful, very useful. And we can graph it to make it visual so that way everyone can understand it. Any manager, any investor, customer, whatever. Yeah. And it also helps us to compare ourselves, our trend, to other companies, our competitors. So just a really cool method. So that's horizontal analysis. Next, I want to talk about vertical analysis. As I had mentioned, with vertical analysis, we're looking up and down the financial statements. We're looking at the balance sheet and the income statement. For the balance sheet, we use a percentage of everything as total assets is the base. Okay? So on your balance sheet, as you know, you have a list of current and long-term assets, and then you have your liabilities, current and long-term liabilities, and then you have your equities, right? So we express everything on the balance sheet expressed as a percentage of total assets. So the way we do that is we take the analysis amount, for example, cash in the current year, divided by total assets for the current year. multiply that by 100, and it gives me the percentage. The percentage, okay? So that's on the balance sheet. On the income statement, we express everything as a percentage of total sales, total revenue, okay? So all of your expenses below, we take the expense amount for, we'll say the current year, divided by total revenue, times 100, gives me the percentage, okay? Now, you might be wondering, Dr. B, why do you call it common size financial statements? Common size. As I mentioned earlier, I gave an example of Marriott compared to Hilton, or Coca-Cola compared to Pepsi. They report their numbers differently. What I mean by that is, Marriott would express their financial statement in thousands, okay, in thousands. We know that their sales are more than thousands. It's more like millions, billions even. Okay. And then Hilton expresses theirs in millions. Now, how are you gonna be able to compare these two different companies that are different sizes? How are you gonna compare them? We do what's called a vertical analysis. For both of their financial statements, income statements, and balance sheets, we run through the vertical analysis in order to compare from a percentage perspective. You see? So that's why we do it. And that's why it's called common size. Okay, so here we have a balance sheet for Apple. Same one you saw before. Okay, we express everything as a percentage of total assets. And so the way that we do it is we take the analysis amount, in this case, current year cash 48. We divide that by total assets, 338. Times 100 gives us 14.4%. Okay, I run through that same exact computation for every single line item on the balance sheet for both years. Okay, because I do the same thing for the prior year, right? 25 divided by 365 is 7.1%. You see? So I run it out for both years. Then what I do, the reason why I do this, is I look at the comparison, from year to year. Say, okay, well, we're up 15% in short-term marketable securities, compared to 11%. Yeah. So what it does is it helps me to put in the company perspective the common size, right? And again, we also do this to compare two companies to each other. And so that's the balance sheet vertical analysis. And then we have the income statement vertical analysis, where we express everything as a percentage of total revenue or total sales. Yeah. So you notice 100% here because 260 divided by 260 is 1, which is 100%. So we take 161, cost of sales, divided by the 260 is 62.2%. I follow that same process, right? 98 divided by 260 is 37. So forth and so on. I do that for all the line items for both years. Why is this important? Why is it useful? So if my cost of sales is 62%, which is high, it's very high. Okay, why is it so high? What was it last year? Oh, it was 61. This year's 62. Why'd it go up? What happened? Oh, maybe there was an increase in the cost of the supplies, the parts. Sure, yeah, that could be part of it. But why didn't our sales go up? Because we didn't pass the cost to the customers. That could be the reason, right? That's why we analyze the financial statements like this. Okay, and yes, of course, we would also compare company to company. We could compare Apple to, we'll say, Samsung. Okay, or whatever. We can do that same type of analysis by comparing the two companies. So that is the vertical analysis for the balance sheet. And then, of course, we can visualize this graphically. Again, being able to understand how to use something like Excel. Oh, it's leaps and bounds, my friends, leaps and bounds. We can graph anything, all kinds of data. So, and I create graphs like this and be able to show a potential investor or a manager who doesn't understand numbers. Believe me, there's a few of them out there. Um, to get it, to understand the performance. So, data visualization is very important, very, very important. And you'll notice, especially now with artificial intelligence kind of leading the way, a lot of companies create what's called dashboards. These dashboards are like this, they're graphs, and I can click on part of that pie chart and zoom in and be able to see all the data behind it. Now we call that a dashboard. There's software out there to help you to create dashboards like Power BI. That's POWERBI, Bravo Indica. This Power BI is a Microsoft product. It's available to you as a student at no cost. It's a part of your Microsoft 365 package. Okay, so I encourage you to look at it, explore it, look through some tutorials, have fun with it, and think about getting a certificate in it or something, because I have a very strong feeling that employers in the future will start to probably require things like this. So, just something to think about. But data visualization is very much at the forefront of a lot of things we do in management and in accounting. So, things to think about. Okay, so we talked about vertical analysis. We talked about horizontal analysis. Now we're going to use the third tool and the one that you all love so darn much, ratios. Okay, so buckle up. This is where we get a little crazy. Now, don't worry about memorizing these ratios. Okay, you're not going to remember all of them. I don't remember all of them. Okay, it's important to know what they are, how they work, and why we use them. Okay, don't worry so much about memorizing the formula. Just focus on the fact of what it is, how it works, and why we use it. Okay? Promise you. Because no one's ever going to memorize these formulas. There's a lot of them. All right? There's a lot of ratios that we use. So this brings us back to the building blocks. Remember, we talked about the building blocks just a little bit ago. And we talked about liquidity. Ashanti told us that liquidity is, or Dominic told us that liquidity is how quickly we can convert things into cash, right? And yeah, that's exactly what it is. But there's a couple of ratios behind liquidity that we're gonna talk about, and how that works. Solvency. Ashanti told us that solvency involves both the short term and the long term. Absolutely, it does, and especially the long term. So we're going to look at ratios of how solvency is calculated. Profitability, of course, the company's ability to generate a profit, satisfy its investors. So we're going to look at a bunch of those ratios. And we'll also look at a few market prospects ratios, which have to do with analyzing things like the stock price and, future trends. Yep. So here we go. There's a lot of them. So liquidity, as you can see, there's a lot of ratios here. There's 1, 2, 3, 4, 5, 6, 7, 8 ratios. Okay, we're going to look at all 8 of them, but I just want you to understand that these particular 8 ratios are used to analyze the liquidity and efficiency of the business. We're going to look at working capital, inventory turnover, current ratio, asset test ratio, day sales uncollected, day sales in inventory, total asset turnover, and accounts receivable turnover. Again, all of these ratios have to do with how quickly we can convert things into cash. Basically. Yeah. So let's take a look at the first one called working capital. What is it? It's the amount of current assets minus current liabilities. Why do we look at it? Because it helps us to understand the position of the company to be liquid, to determine its ability to pay its debt, to continue operating, right? Get that cash, pay that debt, right? So how's it calculated? We take current assets minus current liabilities. That's it. It gives us working capital. The working capital, very useful because again, tells us about the company's ability to pay its debts and continue operating. I'm going to use that additional cash called working capital to work the business, work it forward. Yeah. Oftentimes, businesses use working capital to expand the business, purchase things like property, plant, and equipment. Yeah. Current ratio. I love the current ratio. This is probably one of my favorite ratios. We take current assets divided by current liabilities. That's it. They're both found on the balance sheet. Right. So current assets divided by current liabilities. Remember, the word current means 12 months or less. Right? So why is this my favorite ratio, you might ask? Because it tells me about the company's ability to pay its short-term debt. Okay, I don't want to invest in a company that can't pay its current bills, right? Sears, it was a company. It was a large retailer in the United States. They recently basically went out of business. I think there might be like 3 or 4 stores left out of several thousand that they used to have across the U.S. And you know, I started looking at their current ratio over time. I'm like, oh, things aren't looking so good. They're not paying their vendors. What's going on here? You know, and then you start noticing, hey, then they started going out of business, right? So that's why I love this ratio. It's real quick and easy to compute. And the higher ratio suggests that the company has the ability to pay its current debt. I personally love anything over 1 because that tells me the company can pay its debt, right? Higher than 1, that's even better. But lower than 1, oh, no, 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 no. Don't invest in a company that's less than 1 because that means they're going to go out of business soon. So that's why I like this ratio. Next one's called the acid test ratio. We take cash plus any short-term investments the company might have plus current receivables. Accounts receivable. Yep. Okay, so let me break it down a little bit further. Short-term investments, as you should recall from Principles of Accounting 1, is when the company might purchase a few shares of stock in another company and then sell those. We call those short-term investments. Yeah. Or we might buy certificates of deposit, or also known as a CD, or we might purchase some small stuff. Okay, we hang on to it for a short amount of time and then we sell it. Short-term investments. And then current receivables, accounts receivable. Okay. So cash plus short-term investments plus account receivable divided by current liabilities is the acid test ratio formula. So that's what it is. What does it do? It tells us about the company's ability to quickly convert things into cash. It's a part of liquidity, my friends. Okay, so that's what it does. Yeah, and that's also why it's important because we need to know how quickly a company convert things into cash in order to pay its debt. Yeah, that's why we call it the quick or asset test ratio, sorry. Okay. Then we have accounts receivable turnover. Just as the name implies, it tells us how quickly our customers are paying us that owe us money from accounts receivable. Yep. We take total sales or total revenue divided by average accounts receivable. Remember the word average in accounting means the beginning balance plus the ending balance divided by 2. In accounting, the word average means the beginning balance plus the ending balance divided by 2. Okay? So net sales divided by average accounts receivable tells me how quickly I'm converting my customers' receivables into cash. In this example, 11.3 times. That's very good. About 11 days, roughly. Inventory turnover is the next one. This tells me how quickly I'm selling through my inventory. Oh, okay. Cost of goods sold, found on the income statement, divided by average inventory. Again, that word average. Beginning inventory plus ending inventory divided by 2. This example is 40 times 40 days ish. It's good. It's good. It's got enough inventory. Days sales uncollected. Oh. Days sales uncollected. Very similar to accounts receivable turnover. Very similar. We take accounts receivable divided by net sales. We multiply that by 365 days to find out, again, how long it's taking for customers to pay us. And in this case, 32.2 days. It's about right. It's about right. Days sales and inventory. How long it takes us to move stuff off the shelf. Yep. We take ending inventory divided by cost of goods sold times 365 days. 9.3 days. That's good. It's quick. Total asset turnover. I like this one. Total asset turnover tells us how efficient, this is the efficiency ratio, how efficient we are at using our assets to generate sales. Yeah, that's why I like total asset turnover. We take net sales, total revenue, divided by average total assets. Beginning total assets plus ending total assets divided by 2. Gives you the average. That's a good ratio. I like that one. Okay, so those are all our liquidity and efficiency ratios. Next, we have solvency. Solvency, as Ashanti mentioned, looking at short-term, long-term, right? And so in this, we're looking at how we compare debt, short-term and long-term. Yep. So a couple of ratios: debt ratio, equity ratio, debt to equity ratio, and times interest earned. Okay. Debt ratio, the way I like to think about this is I'm looking at my total equity or total assets in comparison to debt. Total assets in comparison to debt. Total, it basically shows us how efficient I am at paying my debt. Solvency. So here we have the debt ratio and the equity ratio. Okay. So to figure this out, for the debt ratio, we take total liabilities. Remember, liabilities is debt. Divided by total liabilities plus equity. You could also do it by total assets, right? It's the same amount. So total liabilities divided by total liabilities plus equity gives us the debt ratio. Okay, in this example, 73.3%, which is pretty good. Yeah, that's good. They're doing okay. If it was higher, I'd be a little concerned. Total equity ratio. We take the total equity divided by total liabilities plus equity, right? In this case, 26.7%. You'll notice that if I add the debt ratio plus the equity ratio, it gives me 100%. The reason for this is because every single business finances the operations of their business using debt and equity. The combination of both, usually. Okay, typically. Some might use all equity, meaning they don't ever carry debt, which is unusual, but it does happen from time to time. But for the majority of businesses, they use a combination of both debt and equity to operate the business, right? And so that's why the debt and equity ratios, independently and together, are really important to understand. Then we have the debt to equity ratio. This tells us the company's assets which are what we call contributed to creditors. In other words, it tells us the claim, the claim. A large debt to equity ratio implies there is less opportunity to expand the business by using debt financing. In other words, if this ratio gets too high, banks ain't going to lend the company more money. So we take total liabilities divided by total equity, right? That gives us a debt to equity ratio. This example of 2.74. It's okay. It's a little high, but it's not terrible. And the last one's called the times interest earned ratio. Times interest earned ratio is very common, tells us about the company's ability to pay interest expense. In other words, does a company have enough coming in to pay the interest on their loans, right? So to find that, we take income before interest expense and taxes divided by interest expense. Both of these are line items on the income statement. In this case, 19.4 times, that's good. And then the third building block, profitability. Company's ability to generate a profit, of course. We have profit margin, return on total assets, return on equity, and the gross margin ratios. Profit, first by looking at gross profit margin or gross margin ratio, we take sales minus cost of goods sold divided by sales. Sales minus cost of goods sold divided by sales. Tells us the company's percentage of gross margin as it relates to sales dollars. Okay, really important ratio. Absolutely. How much of every dollar is profit? That's what it tells me. Then if we have the profit margin, this is the company's ability to generate profit from each sales dollar. We take net income divided by net sales. Very simple ratio. Yeah, very important ratio. The higher the profit margin, the better. The more profitable the company is. Return on total assets. How efficient is the company using its assets to generate sales, generate profit? We take net income divided by average total assets. Again, that word average. Beginning balance plus ending balance divided by 2. Return on equity. company's ability to pay its common shareholders. Cool. Like a dividend. We take net income divided by average total equity. Beginning balance plus ending balance divided by 2. And then the last building block of ratios is called market prospects. There's 2 ratios I want to tell you about here. One is called price to earnings ratio, and the other one's called dividend yield. The price to earnings ratio tells us the prospect of future growth in the price per share. We take the market price per common share of stock of the company divided by earnings per share. Okay? Earnings per share, you're going to find that on your income statement at the very bottom. And then the last ratio for today is called dividend yield. This tells us the company's ability to pay a dividend in comparison to other companies. We take the annual cash dividends per share, you'll find that in the notes, divided by market price per share. In this case, 1%, that's good. Anything over 1 is good. And these next 2 slides, these are the summary of all of those ratios that we just went through. Now, that's why I mentioned, don't worry about memorizing all of these ratios, okay? Don't worry about memorizing them. Unless you're taking a finance exam tomorrow, then yeah, memorize them. But if you're not, don't, okay? It's important for you to know what the ratios are, what they do, how they work, okay? What do they mean, right? That's the important part I want you to take away from this. And then one of the last things we do to analyze these financial statements after we've done, things like the vertical analysis, horizontal analysis, the ratios. Once we've used those tools, we've analyzed the financial health of the company, we look at all of that information, and we put together some reports to summarize our findings. We put together an executive summary, which is brief results, analysis overview, what tools we use to analyze the financial statements, the evidence, which includes things like the financial statements themselves, ratios that we use, trends, etc. Some key assumptions based off of those trends, any key factors like how well we think the company's doing as it compares to others, and then any inferences we can draw from that, like forecast estimates, etc. So, and then the last thing I want to show you is about sustainable income. It's important for a business to continue operating, right? And how do we get that company to continue operating? We look at the income and how sustainable it is. Meaning, can the company keep generating the same income year after year? Does it need to discontinue certain parts of the business, etc.? Yeah, that's sustainable income in a nutshell. You don't have to worry too much about it. I just wanted to show you what it was. My friends, we made it to the very end of this chapter. Are there any questions you have about analyzing financial statements? Anything that we went over, you're like, Dr. B, I really didn't get that. Or anything else at all? Any type of questions you have? This is your time.
No questions.
Okay. I'm sure you're all bored to death after those ratios because, you're like, oh, Dr. B, you're killing me with the ratios. We did this all, last semester with you in Principles 1. You're doing it to me again. I know it's a lot of ratios, but again, the reason why we go through this is to understand the financial health of the company in a very meaningful way. And it's a way to bridge what you remember, hopefully you remember, from Principles of Accounting 1, bringing that knowledge into Principles of Accounting 2. Okay. So as a reminder, for tomorrow night, I want you to complete your original post for the week 2 discussion board. Just the original post. Okay. about 100 words or so, roughly. And then by Sunday night, I need you to reply to 2 of your classmates in the discussion board and complete the Chapter 17 quiz. Those are the 2 things I need you to complete for this week. Any questions on that? Hopefully you're good.
Sounds good.
All right, Shanti, I'm with you on that. Oscar, you good? I know you're good. You already started us off.
I did.
Okay, I saw your post and I really liked it, so thank you for that.
Thanks, Professor.
Awesome. Okay, again, if any of you ever need anything, you can email me, call me, set up office hours, whatever you need. I'm always here for you 100% of the time. Okay, and with that, stay safe, wash your hands, do the right things, stay warm, and I'll see you all again on Monday night. Thank you so much. Appreciate all of you. Take care.
Yeah, Professor.
Good night, Professor.
Good
Bye,
night.
Professor.
Take
Good
care.
night.
Good night. Good night.